Everybody knows how difficult it is to save up for a down payment on a purchase of a home, but can you borrow money for a down payment? And should you? These are the questions that we're getting into on today's episode of the Mainstream Mortgages podcast. Welcome in, everybody. My name is Derek Vandell, and I'm joined again today by my co-owners of the Mainstream Mortgages franchise, Colton Boudreau and Peter Paley. So, my first question is for Colton. So first of all, when you borrow money for a down payment, what we call that in the mortgage industry is a flex down. So when you're doing a flex down mortgage, you're borrowing money for your down payment. Colton, can you tell me just in simple terms, what does that mean exactly?
Yeah, so in simple terms, you're just borrowing the down payment from a line of credit, a credit card, even maybe an RSP loan. It's essentially you saying to the lender and the insurer that I do not have the funds at this time and I am borrowing them from a different source. And that's different than a gift. It's from one of your credit lines, essentially.
Okay. And can I borrow money from like I don't know, a friend? Would that work?
This is a little bit different. This is just from, like I mentioned, your credit cards, your lines of credit, or an RSP loan.
Okay. And
Technically, can I jump in there? Because we did do one
sure.
years ago that was a loan from a friend, but we needed to have loan terms and a repayment schedule, and everything was done. But I mean, it was an exception, but technically it can be done.
Okay, good to know. And so, Colton, what do lenders look for when they're looking to approve a borrower with borrowed down payment?
Yeah, so first you need a decent credit score. Most lenders need about 650 to 680. They need two active trade lines for at least 2 years of repayment. Um, then they'll need to see an open credit source that has a sufficient amount of room on it to facilitate the down payment, right? So if you don't have that, or your credit cards, say 5,000 limit, you'll either have to update that and increase the limit, or you just outright go get a line of credit or another credit card to help facilitate that. The lenders will also, I guess the insurers, I should say, will also premium your rate. So it goes up by zero point 0.5 on top of the already normal mortgage insurance. So that's a factor. Other than that, lenders are just, looking for the basic stuff like your letters of employment, your pay stubs, and then, you know, lines of credit to facilitate the down payment.
Okay, so just to be super clear, you said that some lenders will increase the rate, right? And you're
The
talking about
insure
just the
the
default
insurer,
insurance?
yes,
Okay.
correct. Sorry,
So the regular mortgage rate is still the
remains
same?
the same.
Okay. And can this be used on all types of purchases? Or like could I go and borrow money to buy a rental property, for
No, so
example?
this is for your owner occupied residence, and it will be 5 to 10%, typically 5%.
Okay. And when you do borrow money for a down payment, how does the lender factor in those payments that you have to make on the borrowed money? Like, how does that affect your mortgage application as a whole?
Yeah, so any amount of money you are borrowing for the down payment and closing costs then will have to be factored into your mortgage application. You will have to be, like on our side, it will be factored in at 3% of that balance will be accounted for in your mortgage application. So it's really going to hinder your purchasing power. Um, and you kind of mentioned, do we recommend it? We would normally say no. If you can save money, try to save money, obviously, and come up with a down payment on your own end. But if you can't or you need this resource, then absolutely okay. There's just a couple more stipulations that come with it and that you have to follow. Or
Okay. And
Can
just
I
for
just jump?
anybody,
Can I just jump
yeah,
in
go
there
ahead,
too?
Peter.
Because not only do you don't always just need a credit card or a line of credit. You can actually go apply for a term loan that's unsecured, and you can also use that money. And then the lender would use the actual loan payment to help debt service for the mortgage. So, I mean, this program isn't for everyone. And maybe it's not that you borrow 100% of your down payment and closing costs, but maybe you have 10,000 saved and it's not enough and you need to borrow another 5 or 10,000 to just get a house that suits your needs. So like that would be something more what I think this program would be for than borrowing 100% of your down payment and closing costs.
Right. And I think for anybody curious about like how much this would affect your application if you did borrow money for a down payment, I can say just a general guideline, general numbers. If you're borrowing anywhere between 13 to $15,000 for your down payment, that will probably reduce the amount of mortgage that you can qualify for by about $100,000, just as a general rule of thumb.
Yeah, general rule of thumb.
Yeah. So moving into Colton, you mentioned RSP loans before. So Peter, can you explain to me just simple terms, what is an RSP loan for anyone who maybe hasn't heard of it?
So RSP loans were really designed to help people catch up on their RSP contributions to set them up for retirement. But in the mortgage space, we figured out that a lot of people withdraw from their RSPs under the home buyer's plan, which allows you to withdraw your down payment and closing costs up to $35,000 without any taxes owing on your RSP withdrawal. And the government gives you 15 years to pay that back. So, us being brilliant mortgage minds that we are, we thought, why not get our clients an RSP loan through their financial institution or financial planner, let the money sit in the RSP for the required 90 days that it takes for the money to be allowed to be withdrawn under the home buyer's plan. And then you can withdraw that whole amount of your RSP and use it towards your down payment and closing costs. But the thing that you need to be careful about is, let's say you do a $20,000 RSP loan and you amortize that over 5 or 10 years, and it comes with a payment of $500 a month to $1,000 a month. We factor that into your mortgage application. But what you need to know also as the borrower is CRA is going to come knocking every door and expecting you to be paying back a portion of the RSP withdrawal back on your income taxes. So they generally stipulate 1/15 every year needs to be repaid back to that. So you would have your RSP loan to pay, and then you'd also have to pay the money you withdrew from your RSP back and replace it.
So what are the I guess risks or mistakes that people make with the RSP loan strategies?
Well, I don't really see too many mistakes other than you really need to know what you're getting into before you do it. I think it's a really great way to sort of do a double dip because not only are you making your RSP contribution, so when you file your taxes in the following year, you're reducing your income and hopefully increasing your refund. So, I don't really I see that more as a benefit than as a risk. And I mean, just keep in mind you have to make the loan payment and repay the RSP withdrawal back to your RSP within the 15-year period. And I really think you just need to understand that and make sure um, you have your household budget done and it can accommodate that because you could quickly get into debt a lot quicker. And of course, we'd reference our household budget episode of the Mainstream Mortgages podcast if you wanted to do your own budget.
Absolutely. So that's basically RSP loans in a nutshell. Colton, I guess Peter did touch on it a little bit, but can you kind of maybe bring in your 2 cents? When does a borrowed down payment strategy make sense, and when should someone maybe not use it?
Yeah, I think relying on it as an entire, your entire down payment and closing costs, like Peter alluded to, I think is not the smartest strategy because one, now you're taking out that new mortgage. Two, you've just racked up your credit cards or your lines of credit or whatever it might be, right? So now there's another payment on a new mortgage payment. So all of a sudden you're accruing this debt that maybe you didn't have prior, or maybe you didn't think about, honestly. Whereas I think it can lead to a slippery slope, and where I would say most clients aren't so certain if they can make both payments or even should. Um, so I, like Peter alluded to, I think getting them over the hump if they need that extra $5,000 or whatever it might be to top up their 10,000, I think that is when it makes the most amount of sense.
I'm going to jump in there too, just to like add
Sure.
another scenario. Let's say somebody saved up $5,000 or $6,000 for their down payment. Well, that's not enough, and mom and dad are gifting um, ten or $15,000, and maybe that's still not enough. You can use this program to maybe top up your down payment to what you need. And Where I really see this kind of being really beneficial is someone finished school, they're a professional now, they got their job, they're making lots of money, but they don't have their down payment saved up. So this could be a really great way to maybe skip a rung in the property ladder instead of buying like a starter condo or a starter home, like maybe you can get into your 10 or 15-year house with this, which really saves you a lot of money in the long run. So that's one scenario that you can do. And I just wanted to circle back to the where you can also borrow the funds from. Like there's car refinancing companies. If your car's not too old, or maybe you've paid your car off really fast, you can actually access equity in your car again to use for this down payment program. Maybe you own a boat or an RV, you can refinance those now. There's a lot of different ways where we have access to funds because I mean, putting it on a 20 or 28% interest credit card maybe isn't the best thing to do. But if you need like a couple $1,000s, maybe not the end of the world, but you just want to really be sure that you've really thought it out and that budget's done and that you factor in all these expenses because it's not just now your mortgage, principal, interest, insurance, utilities, taxes, all that. Now you have another payment, which is probably at higher interest. Like, I mean, even on an RRSP loan or a regular term loan, you're probably between 7 and 11% interest. So it's just something to factor in for total costs. And I think those are some of the things that people really need to be aware of.
Absolutely. Yeah, you mentioned one of the scenarios is maybe a student, a professional who just graduated making a lot of income. I think that's um, a general thing to kind of take away from this as well. The borrowed down payment kind of, like I said before, reduces the amount that you qualify for. But if you have good income, then that doesn't really matter, right? So I guess it's kind of for people with a little bit higher income, or if they want to, purchase well below what they would normally qualify for, that works too, right? So I think that wraps up today's episode on borrowed down payments. If you guys have anything else you want to say, anything? No?
No, I'm good.
Believe it or not, I think I'm good. I think I got it all in the allotted time today.
Amazing. Amazing. All right. Well, thank you everybody for listening to today's episode of the Mainstream Mortgages podcast. Please reach out to us if you have questions about borrowing money from a down payment. Maybe you have a creative source of money that you think that you can borrow from or access money from. Reach out to us, ask us, does this work? Would this qualify for borrowed down payment? Or maybe it qualifies for your own resources. Just let us know and we'll be happy to answer those questions. You can reach out to us by text or phone at 431-482-2187. And you can email us at greatrates@mainstreammortgages.com. Thanks again, and we'll see you on the next one.
Thank you.